Welcome. Today, we need to discuss something that demands your full attention. Silver has experienced a dramatic price decline from $107 per ounce to $103, a 12% drop in a matter of days. If you hold silver, you might be feeling concern. If you've been watching from the sidelines, you might sense opportunity. Both reactions are natural. Both require careful consideration. This isn't a moment for panic. It's not a moment for impulsive decisions driven by fear or greed. This is a moment that separates disciplined investors from reactive traders. Let me be direct with you. Markets don't move in straight lines. Assets that rise rapidly can fall rapidly. The question isn't whether volatility will occur. The question is whether you understand what's happening and how to respond strategically. Over the next 25 minutes, I'm going to walk you through this situation with the same clarity and composure I would bring to my own portfolio decisions. We're going to examine what's driving this movement. We're going to explore what history teaches us about similar scenarios. And we're going to discuss specific, actionable approaches for your particular situation. You deserve better than clickbait headlines and emotional manipulation. You deserve analysis grounded in market reality, investor psychology, and practical risk management. Here's what you need to understand right now. When silver moved from $117 to $103, something significant happened beneath the surface. Smart money made decisions. Institutional players adjusted positions. Market dynamics shifted in ways that most casual observers completely missed. The retail investor sees a price drop and feels fear. The institutional investor sees a price drop and asks questions. Why now? What triggered this? Who's selling? Who's buying? What does this tell us about market structure? That's the mindset we're adopting today. Not emotion, not speculation, analysis. Silver isn't just another commodity. It occupies a unique position in global markets. It's an industrial metal essential for technology, solar panels, and electronics. It's a monetary metal with thousands of years of history as a store of value. It's a portfolio diversifier that responds to currency concerns and inflationary pressures. This triple identity creates complexity. It also creates opportunity for those who understand the forces at play. The movement from $117 to $103 didn't happen in a vacuum. It happened within a broader context of monetary policy decisions, currency fluctuations, industrial demand patterns, and investor sentiment shifts. Each of these factors matters. Each tells part of the story. Before we continue, let me establish something fundamental. This script contains no guarantees, no promises of wealth, no predictions of specific future prices. What you'll receive instead is far more valuable, a framework for thinking clearly during market volatility. Take a deep breath. Set aside the emotional reaction you might have had when you first saw the price movement. We're about to examine this situation with the calm professionalism it deserves. Silver dropped from $107 to $103, 12%. For some context, a 12% move in a traditional stock portfolio would be considered dramatic. In commodities markets, particularly precious metals during volatile periods, these movements occur with greater frequency. But frequency doesn't make the movement less significant. It simply means we need to understand the mechanisms that drive such volatility. First, let's address the obvious question. Was this decline unexpected? The answer depends on your time frame and perspective. If you zoomed in only on the past few weeks of price action, watching silver climb steadily, then yes, this correction might feel sudden. But if you step back and examine the broader pattern, you'll notice something important. Parabolic rises rarely sustain themselves. When any asset climbs too steeply, too quickly, it builds internal tension. That tension eventually releases through price corrections. And this isn't a flaw in the market. It's how markets function. Think of it like a rubber band. Stretch it gradually and it maintains elasticity. Stretch it too rapidly and it snaps back. Silver reached a point where the rate of ascent exceeded what market structure could comfortably support. Now, let's discuss who sold and why. This matters more than most investors realize. When silver hit $117, certain holders made a calculated decision. They determined that current prices represented an attractive exit point for positions they'd held through the entire rally. These weren't panicked sellers. These were disciplined profit takers. Imagine you purchased silver at $65 per ounce. You've watched it nearly double. At $117, you're sitting on substantial gains. Do you hold indefinitely, hoping for $150, $200 or higher? Or do you lock in a meaningful portion of those profits? Smart money understands that no one ever went broke taking profits. They also understand that markets reward patience but punish greed. This profit taking creates selling pressure. As large positions liquidate, price drops. As price drops, technical traders who follow momentum strategies exit their positions. As those positions close, additional selling pressure emerges. The cycle reinforces itself. This is called a cascade effect. It's neither good nor bad. It's simply a mechanical reality of how markets operate. We need to discuss leverage because it played a significant role in this decline. Many traders in commodities markets use leverage to amplify their exposure. They might control $100,000 worth of silver with only $20,000 in actual capital. When prices move in their favor, profits multiply. When prices move against them, losses multiply just as quickly. At $117, many leveraged positions faced a critical decision point. As silver began declining, these positions hit stop-loss orders designed to limit losses. Those stop losses triggered automatic selling. That selling pushed prices lower. Lower prices triggered additional stop losses. The pattern repeated. This technical selling has nothing to do with silver's fundamental value. It has everything to do with position management and risk controls. But the effect on price is identical whether selling comes from fundamental concerns or technical necessity. Here's what matters for you. When you see sharp declines in leveraged markets, a significant portion of that movement often reflects position unwinding rather than genuine shifts in long-term value assessment. Now let's zoom out further. Silver doesn't exist in isolation. It responds to larger economic forces. Central bank policies matter enormously. When interest rates rise, the opportunity cost of holding non-yielding assets like silver increases. When rates fall, that dynamic reverses. Current monetary policy worldwide remains in a state of transition, creating uncertainty that manifests as volatility. Currency movements play a crucial role. Silver is priced in US dollars. When the dollar strengthens, silver typically faces headwinds. And when the dollar weakens, silver often rallies. Recent dollar strength contributed to silver's decline from 117. Industrial demand patterns affect silver differently than gold. Approximately half of silver consumption serves industrial purposes. Economic concerns in major manufacturing economies can depress industrial demand expectations, putting downward pressure on prices. None of these factors change dramatically overnight. But markets don't move based on gradual changes alone. They move based on shifting interpretations of existing conditions. Sentiment shifted. The narrative changed. Price followed. Let me share something that might provide perspective. Silver's behavior today echoes patterns we've seen before. In 2011, silver reached approximately $49 per ounce before correcting sharply to $32 within days. That represented a 35% decline. The fundamental case for silver remained intact. Industrial demand continued. Monetary concerns persisted. Yet price fell dramatically. What happened next? Silver spent years consolidating, building a base, and eventually found support at lower levels before beginning its next major advance. In 1980, silver spiked to $50 per ounce, driven by the Hunt brothers' attempted market corner. It subsequently crashed to below $10. The correction was brutal. Those who bought at the peak suffered. Those who accumulated during the aftermath and maintained patience eventually saw a recovery decades later. The point isn't to predict silver will follow identical patterns. The point is to recognize that volatility is intrinsic to this asset class. Corrections don't invalidate long-term thesis. They test conviction and discipline. Understanding crowd psychology helps make sense of these movements. During rallies, optimism builds. As prices rise, media attention increases. New participants enter, often with limited understanding of the asset or its typical behavior patterns. FOMO, fear of missing out, drives decisions rather than analysis. These late entrants buy near peaks. They lack the conviction that comes from thorough research and understanding. When prices correct, they panic. They sell at losses. Their selling amplifies the decline. Meanwhile, experienced investors who understand market cycles remain calm. They recognize corrections as part of the journey. They don't view temporary price declines as catastrophic events. They view them as normal market behavior. This psychological divide creates opportunity. When fearful sellers meet patient buyers, assets change hands. Wealth transfers from emotional hands to disciplined hands. Which side of that transaction do you want to be on? Let's address the concept of smart money making bold moves. Smart money doesn't refer to infallible predictors of the future. It refers to investors and institutions with several key characteristics. They have longer time horizons. They have robust risk management frameworks. They have emotional discipline. They base decisions on analysis rather than reaction. When smart money acts during volatility, they do several things. They assess whether fundamental value has changed. They evaluate risk-reward ratios at new price levels. They consider position sizing based on conviction and portfolio context. They act when others are paralyzed by fear or driven by greed. Some smart money took profits at $117, locking in gains from lower entry points. Other smart money began accumulating at $103, viewing the correction as creating more attractive entry opportunities. Both actions represent discipline rather than emotion. Your goal isn't to perfectly time every market turn. Your goal is to develop the same disciplined framework that characterizes smart money behavior. Beneath all the price volatility, fundamental supply and demand dynamics continue operating. Silver mine production faces constraints. High-grade deposits are finite. Mining costs set a floor beneath which prices cannot sustainably fall without triggering supply reductions. New mine development requires years and substantial capital investment. On the demand side, industrial applications continue growing. Solar panel manufacturing consumes massive amounts of silver. Electric vehicle production requires silver. 5G infrastructure build-out creates demand. These aren't speculative future needs. These are current, ongoing consumption patterns. Investment demand adds another dimension. When currency concerns rise, investors seek tangible assets. When inflation expectations increase, precious metals attract capital. These flows can be volatile, but the underlying driver, desire for monetary alternatives, remains relevant. At $117, some of these fundamental factors may have been fully priced in. At $103, the risk-reward calculation shifts. We're not saying $103 represents guaranteed value. We're saying the margin of safety increased compared to $117. Interest rates deserve specific attention because they create a powerful cross-current for silver. When rates rise, bonds become more attractive relative to non-yielding assets. Money flows from commodities to fixed income. When rates peak and begin declining, that dynamic reverses. Capital seeks alternatives to bonds and commodities benefit. We're currently in a complex environment where inflation concerns compete with recession risks. Central banks balance fighting inflation against avoiding economic contraction. This creates policy uncertainty that manifests as asset price volatility. Silver responded to recent interest rate signals. As rate expectations shifted, so did silver's attractiveness relative to other assets. The move from $117,000 to $103 partially reflects this recalibration. Understanding these connections helps you interpret price movements beyond simple up is good, down is bad thinking. Context matters. While we won't speculate on specific geopolitical scenarios, we must acknowledge their influence. Precious metals respond to geopolitical uncertainty. When international tensions rise, safe haven demand increases. When tensions ease, that demand moderates. Silver, despite its industrial applications, maintains this monetary metal characteristic. Recent geopolitical developments created uncertainty. Markets incorporated that uncertainty into prices. As situations evolve, prices adjust. This process rarely moves smoothly. Instead, it lurches between extremes as market participants react to new information. The correction from $117 to $103 occurred within this broader context. Separating price movement into neat, single-cause explanations oversimplifies reality. Multiple factors converge simultaneously. Here's what the decline from $117 to $103 actually tells us. It tells us that silver remains a volatile asset prone to sharp movements. It tells us that leverage amplifies these movements beyond what fundamentals alone would justify. It tells us that late-cycle entrants with weak conviction sold under pressure. It also tells us that despite a 12% decline, silver still trades dramatically above where it stood months ago. Context matters. A correction within a broader uptrend differs from a breakdown signaling trend reversal. It tells us that markets remain functional. Prices adjust. Supply meets demand. Excess is correct. This healthy price discovery process, however uncomfortable it feels in real time, maintains market integrity. Most importantly, it tells us that your response to the situation matters far more than the situation itself. Assets will fluctuate. Your behavior determines outcomes. Let's address your specific situation directly. You own silver. Price dropped 12%. What should you do? The first answer is probably nothing immediate. Let me explain why. If you purchased silver based on a sound long-term thesis, has that thesis changed? Did industrial demand suddenly disappear? Did mine supply dramatically increase? Did the fundamental reasons you bought the asset evaporate overnight? If the answer is no, then temporary price volatility shouldn't trigger hasty decisions. In fact, reacting to every market fluctuation represents one of the most reliable paths to poor investment outcomes. Warren Buffett once observed that the stock market is a device for transferring money from the impatient to the patient. The same principle applies to silver markets. However, and this is important, unchanged fundamentals don't mean blind holding regardless of circumstances. Take time now to genuinely reassess your original reasons for owning silver. Were they sound? Did you buy based on careful analysis or emotional reaction to rising prices? Did you invest capital you can afford to have tied up in a volatile asset? If your original thesis was silver is going up and I don't want to miss out, then you didn't have a thesis. You had an emotional reaction. That requires honest acknowledgement and possibly different decisions moving forward. If your original thesis was, I believe silver serves as a hedge against currency debasement and my portfolio benefits from alternative asset exposure, then a 12% correction doesn't invalidate that reasoning. Distinguish between your investment thesis and your emotional comfort. They're different things. Let's discuss position sizing because this determines whether volatility causes discomfort or disaster. If silver represents 5% of your portfolio, a 12% decline equals a 0.6% impact on total portfolio value. That's noise. It shouldn't cause sleepless nights or panic selling. If silver represents 50% of your portfolio, that same decline causes a 6% portfolio impact. That's significant. It might indicate improper position sizing from the start. Here's a crucial principle. No single asset should dominate your portfolio to the extent that its volatility threatens your financial security or psychological well-being. If silver's decline from $117 to $103 caused genuine distress, you may be overexposed. Consider whether rebalancing makes sense, not panic selling, not capitulating, but thoughtfully reducing position size to a level that allows you to weather volatility without emotional disruption. Remember, the goal is staying in the game long enough for your thesis to play out. Over-leveraged positions force exits at the worst possible times. Should you buy more silver at $103 if you already own it at higher prices? This strategy, called averaging down, can be effective or disastrous depending on context. If you bought at $115 based on solid analysis and nothing fundamental has changed, buying more at $103 reduces your average cost. If silver eventually rises, your entire position benefits. This requires capital reserves and emotional discipline. However, averaging down into a deteriorating asset compounds mistakes. If you bought at $115 because of hype and fundamentals never supported that price, buying more at 103s throws good money after bad. The distinction lies in honest assessment. Are you averaging down into quality that temporarily declined? Or are you averaging down into an error you should acknowledge and correct? Only you can answer that question. But answer it honestly, not based on hope or ego protection. If you're considering selling, understand the tax consequences before acting. In many jurisdictions, selling silver held less than a year triggers short-term capital gains taxes at ordinary income rates. Selling after 1 year may qualify for lower long-term capital gains treatment. The tax impact can significantly affect your net outcome. Additionally, if you sell at $103 after buying at $115, you realize a loss that might offset other capital gains for tax purposes. This loss harvesting strategy has legitimate applications, but should be part of broader tax planning, not panic reaction. Consult with tax professionals regarding your specific situation. Tax-driven decisions differ from investment-driven decisions. Both matter, but understand which one is driving your behavior. Here's what I need you to understand if you're feeling anxious about your silver position. Volatility is the price you pay for potential returns in asset classes like silver. You cannot have the upside without accepting the downside. They're inseparable. If silver had continued straight up from $107 to $150 without any corrections, would you have felt your investment strategy was vindicated? Probably, but that's not how markets work. They're messier, more unpredictable, and more emotionally challenging than we'd prefer. Your job isn't to avoid volatility. Your job is to ensure volatility doesn't force you into decisions you'll regret. The investors who succeeded in precious metals over decades weren't those who never experienced drawdowns. They were those who maintained perspective during drawdowns and avoided panic-driven exits. Let's be balanced. Sometimes selling is the correct decision. If you've realized your financial situation changed and you need liquidity, selling makes sense regardless of current price. Life happens. Emergency needs supersede investment strategy. If your honest reassessment concludes your silver position was a mistake from the start, not based on sound analysis, then selling might be appropriate. Admitting mistakes is strength, not weakness. If your position size genuinely threatens your financial stability or psychological health, reducing exposure makes sense. No investment is worth your well-being. But selling because of fear, because price dropped 12%, because you read alarming headlines, because your neighbor sold, those aren't sound reasons. Those are emotional reactions that consistently produce poor outcomes. Moving forward, establish clear decision rules before emotions run high. Decide in advance under what conditions you would sell. Write them down. Make them specific. I will sell if my original thesis is invalidated by X, Y, or Z. Or, I will sell if my position exceeds X% of portfolio value. Or, I will take partial profits if price reaches X level. These predetermined rules prevent reactive decision-making during stressful periods. They create structure that supports discipline. Review these rules periodically during calm periods. Adjust them based on changing circumstances. But once established, follow them. That's what separates strategy from emotion. Now let's address those of you watching from the sidelines wondering if $103 represents an opportunity. First question, why are you considering silver now? Is it because price dropped and you're hoping to catch a bounce? That's trading, not investing. Trading requires different skills, different capital allocation, and different risk management than we're discussing here. Or are you considering silver because you've studied its role in portfolios, understand its characteristics, and believe allocation to alternative assets makes strategic sense? That's investing. That deserves serious consideration. Be honest with yourself about your motivation. Your answer determines everything that follows. Before allocating capital to silver, understand what you're actually buying. You're buying a volatile asset that offers no cash flow. It generates no dividends or interest. Its value derives entirely from others' willingness to pay more in the future or its utility in industrial applications. You're buying an asset with a 5,000-year history as money, but no guarantee that history repeats. You're buying a hedge against specific risks: currency debasement, systemic financial instability, and inflation. You're buying an asset that can drop 12% in days, as we just witnessed. And you're buying into a market where timing matters less than time horizon. If those characteristics make you uncomfortable, silver probably isn't appropriate for you. That's perfectly fine. Not every asset suits every investor. Is $103 a good entry point? I'm not going to tell you yes or no, because anyone claiming to know is either dishonest or delusional. What I can tell you is this: $103 is 12% cheaper than $170. The asset purchased at $103 requires less appreciation to achieve any given return target than purchasing at $117. That's a mathematical fact. Additionally, $103 is substantially higher than where silver traded a year ago. Context matters. Are you buying a temporarily discounted asset within an uptrend? Or are you buying near still elevated levels before further declines? No one knows with certainty. That's why position sizing matters more than perfect timing. If you decide to initiate a silver position, start small. Let me be specific. If you're allocating to silver for the first time, consider beginning with no more than 2 to 5% of your investable assets. This provides meaningful exposure if silver rises, while limiting damage if it falls further. Many investors make the mistake of taking aggressive positions in assets they don't yet understand. They experience one significant move against their position and exit permanently, often at the worst possible time. Better approach: start with a starter position, learn how the asset behaves, learn how you react to its volatility, learn whether you can sleep at night holding it. Then, and only then, consider adding to the position if analysis and experience justify increased allocation. This measured approach might mean missing some upside if silver immediately rallies from $103, but it definitely means avoiding catastrophic downside if your timing is poor or your risk tolerance is lower than you estimated. Consider spreading your entry across time rather than committing all capital immediately. Dollar cost averaging means investing equal amounts at regular intervals, regardless of price. Buy $500 worth of silver per month for 12 months rather than $6,000 all at once. This approach removes timing pressure. You'll buy some at $103, some at higher prices, some at lower prices. Your average cost will reflect the entire range. You avoid the psychological trauma of watching a large lump sum investment immediately decline. The downside? If silver consistently rises from $103, you'll achieve lower returns than someone who invested everything immediately. But since none of us can predict that outcome with confidence, the reduced psychological stress and risk management benefits often outweigh the potential opportunity cost. This strategy works particularly well for volatile assets like silver. You need to decide how to gain silver exposure. Physical metal, ETFs, mining stocks, each carries different characteristics. Physical silver means you own tangible metal. You control it, you store it, you insure it. You bear those costs, but gain direct ownership and independence from counterparty risk. ETFs provide convenient exposure without storage concerns, but you own shares of a fund, not actual metal. Counterparty risk exists. Tracking isn't always perfect. Mining stocks offer leveraged exposure to silver prices. When silver rises, profitable miners rise more, but their businesses subject to operational risks unrelated to silver prices. For most investors, particularly those new to silver, a combination makes sense. Some physical holdings for direct exposure, some ETF exposure for convenience and liquidity, perhaps some minor exposure for growth potential if you're willing to accept higher volatility. No single approach is right. Understand the trade-offs and match them to your preferences and capabilities. Here's a non-negotiable requirement. If you're considering silver, you need a multi-year time horizon. If you need this capital within the next year, silver is probably inappropriate. Volatility could push prices lower before they move higher. You might be forced to liquidate at unfavorable prices due to liquidity needs. If you have a 5 to 10 year horizon, short-term volatility becomes noise. You can ride through corrections. You can potentially add to positions when prices temporarily weaken. You give your thesis time to play out. Ask yourself honestly, can I commit this capital for the long term? If not, reconsider whether silver makes sense for you right now. Let's discuss expectations, because mismatched expectations destroy more investment outcomes than poor analysis. Silver is not a get-rich-quick scheme. It's not going to double overnight and make you wealthy. Anyone promising such outcomes is selling you something, not educating you. What silver might do over extended timeframes is provide portfolio diversification, serve as insurance against specific macroeconomic scenarios, and potentially appreciate if its fundamental drivers strengthen. That's less exciting than promises of 500% gains. It's also grounded in reality rather than fantasy. If your expectations are reasonable, you can remain patient. If your expectations are inflated, you'll become frustrated, sell at the wrong time, and blame the asset rather than your unrealistic assumptions. And now we need to discuss mistakes that destroy wealth. Pay close attention, because recognizing these patterns could save you thousands or tens of thousands of dollars. Mistake number 1, making decisions driven by fear or greed rather than analysis. When silver hit $117, did you feel the urge to buy because of excitement about rising prices? When it dropped to $103, did you feel the urge to sell because of fear about further declines? Both impulses are emotional reactions, not strategic decisions. Markets are designed to exploit emotion. They push prices high enough to attract greedy buyers at peaks. They push prices low enough to trigger fearful selling at bottoms. Wealth transfers from emotional participants to disciplined participants. Your job is recognizing when emotion drives your decision-making and creating systems that override those impulses. Mistake number 2, using excessive leverage to amplify exposure. I cannot emphasize this strongly enough. Leverage transforms manageable volatility into catastrophic risk. If you control $50,000 worth of silver with $10,000 in capital, a 20% decline forces liquidation of your entire position. You don't get to participate in any eventual recovery. You're out. Game over. Leverage creates the illusion of enhanced returns during favorable moves, but it guarantees destruction during unfavorable moves. The mathematics are unforgiving. Use leverage only if you're an experienced trader with robust risk management systems and capital you can afford to lose entirely. For long-term investors, leverage is almost always a mistake. Mistake number 3, allocating too much capital to a single asset. Diversification isn't just prudent theory, it's practical risk management. No matter how convinced you are about silver's prospects, concentrating excessive portfolio weight in a single volatile asset creates unnecessary danger. What percentage is too much? That depends on your overall financial situation, risk tolerance, and other holdings. But as a general guideline, if a 20% decline in silver would cause genuine financial hardship, you're overallocated. Successful investing requires surviving drawdowns. Overconcentration makes survival harder. Mistake number 4, monitoring prices constantly and reacting to every movement. If you check silver prices hourly or daily, you're sabotaging your own success. Constant monitoring triggers emotional responses to routine volatility. You'll see drops that feel catastrophic, but are actually normal market noise. Decide on a reasonable monitoring frequency. Weekly? Monthly? Match it to your time horizon. If you're investing for 5 years, daily price movements are irrelevant noise. Create healthy distance between yourself and minute-by-minute price changes. Your psychological well-being and investment outcomes will both improve. Mistake number 5, basing decisions on what everyone else is doing. When silver hit $117, were mainstream media outlets celebrating precious metals? Was social media filled with silver bulls? That's a warning sign, not validation. Extremes in sentiment often coincide with market turning points. When silver dropped to $103, did panic selling dominate discussions? Did commentators declare the rally over? Again, extreme sentiment often signals opportunity rather than risk. Think independently. Analyze independently. Decide independently. The crowd is consistently wrong at inflection points. Mistake number 6, either using stop losses inappropriately or ignoring risk management entirely. Stop losses serve a legitimate purpose. They prevent small losses from becoming catastrophic. But in volatile assets like silver, setting stops too tight guarantees you'll be shaken out by normal volatility. If you're a trader, use appropriately placed stops based on technical analysis and volatility measurements. If you're an investor, stop losses might be inappropriate because your holding period extends beyond short-term volatility. The mistake is either having no exit plan whatsoever or having an exit plan designed for a different strategy than you're actually pursuing. Mistake number 7, believing anyone who claims certainty about future prices. If someone tells you silver will definitely reach $200, they're either lying or fooling themselves. If someone tells you silver will definitely fall to $50, same problem. No one knows future prices with certainty. Markets are complex systems influenced by countless variables. Probability and risk management matter. Certainty is an illusion. Be deeply skeptical of anyone offering guaranteed outcomes. They're selling a product or service, not providing objective analysis. Mistake number 8, waiting for the perfect price instead of executing a reasonable strategy. Investors often wait for silver to drop just a little more before buying. It rises instead. They wait for it to rise just a little more before selling. It falls instead. Meanwhile, disciplined investors executed reasonable plans at reasonable prices and moved on. Perfect timing is impossible. Reasonable timing based on analysis and position sizing is achievable. Don't let perfect be the enemy of good. Mistake number 9, failing to account for the friction costs of trading. Every transaction carries costs. Spreads between buy and sell prices, commissions, shipping for physical metal, storage fees, insurance. These costs erode returns. Taxes matter too. Frequent trading can trigger short-term capital gains. Transaction costs and taxes combined can eliminate modest gains entirely. Build these costs into your strategy. They're part of the reality of investing, not optional considerations. Mistake number 10, believing a compelling story without verifying facts. Silver has a compelling narrative. Finite supply, industrial demand, monetary history, currency concerns, all true. But narrative alone doesn't determine prices. Timing, sentiment, capital flows, and countless other factors influence outcomes. Verify claims. Question assumptions. Distinguish between what makes sense logically and what the data actually shows. Good storytelling doesn't equal sound investment. We've covered substantial ground in the past 25 minutes. And let's distill the key insights you need to carry forward. Silver dropped from $117 to $103, 12%. This volatility is normal for this asset class. It doesn't invalidate long-term fundamental drivers. It doesn't guarantee further declines or imminent recovery. It's market behavior. Your response determines whether this volatility helps you or hurts you. Disciplined investors navigate volatility successfully. Emotional reactors do not. If you own silver, reassess your thesis honestly. If it remains sound and your position size is appropriate, maintain discipline. If either factor has changed, make thoughtful adjustments. Don't panic. Don't react. Think. If you're considering entering a position, understand what you're buying. Start with appropriate position sizing. Extend your time horizon to multiple years. Manage expectations realistically. Silver might perform well over time. It might not. Build your strategy to weather either outcome. Here's what separates successful investors from the rest. Not intelligence, not access to secret information, not perfect timing. Discipline. Discipline means following your strategy when emotions scream at you to abandon it. Discipline means sizing positions to survive worst-case scenarios, not just benefit from best-case scenarios. Discipline means accepting that uncertainty is permanent and adapting to it rather than fighting it. You cannot control market prices. You cannot control macroeconomic forces. You cannot control what other investors do. You can control your own behavior. That's enough. Investors who built lasting wealth did so by controlling the one variable they could control: themselves. Remember that investing is a marathon, not a sprint. The silver price tomorrow, next week, or next month tells you almost nothing about where it will be in 5 or 10 years. Markets reward patience. They punish impatience. The time horizon you choose largely determines your results. If you're playing the long game, short-term volatility is just noise. If you're playing the short game, you're trading, which requires different skills and carries different risks than we've discussed today. Choose your game and play it consistently. Don't switch between investing and trading based on emotions. Everything we've discussed rests on one foundation: risk management. Without proper risk management, intelligence and analysis are worthless. With it, you give yourself the chance to succeed. Risk management means never putting capital you cannot afford to lose into volatile assets. It means sizing positions appropriately. It means maintaining emergency funds so you're never forced to liquidate investments at unfavorable times. It means understanding that preservation of capital takes priority over pursuit of gains. Losing less in bad times matters more than gaining more in good times. Build your investment approach on this foundation. Everything else follows from it. Here's what I want you to understand as we close. You have more control than you think, not over markets, over yourself. You can choose to respond rather than react. You can choose strategy over emotion. You can choose patience over impulsiveness. You can choose learning over repeating mistakes. The movement from $117 to $103 changes nothing about your capabilities. It simply reveals whether you've developed those capabilities yet. If this volatility caused panic, use that as information. You've learned something about your risk tolerance and position sizing. Adjust accordingly. If this volatility caused calm assessment and strategic thinking, you're developing the mindset that succeeds long-term. Keep building on that foundation. I cannot tell you what silver will do next. Neither can anyone else, regardless of their credentials or confidence. What I can tell you is how to approach uncertainty. Build a sound thesis based on facts. Size positions to survive being wrong. Extend your time horizon to allow your thesis to play out. Maintain discipline when emotions run high. This framework works regardless of whether silver rises to $150s or falls to $80, Because it's not about predicting the future. It's about preparing for multiple possible futures. You have the information you need, you understand what happened, why it happened, and how to think about it strategically. The rest is execution. Take time to reflect before acting. Review your positions, assess your thesis, examine your risk management, make decisions from a place of calm analysis, not emotional reaction. If you're a holder, recommit to discipline or make thoughtful adjustments. If you're a potential investor, decide whether silver fits your strategy and execute with appropriate caution. Markets will continue fluctuating. Silver will experience more volatility in the future. Uncertainty won't disappear. These are constants. What changes is your ability to navigate these constants effectively. You become better at recognizing emotional responses before they drive decisions. You become better at distinguishing signal from noise. You become better at maintaining perspective during stressful periods. This improvement doesn't happen overnight. It happens through experience, reflection, and commitment to learning from both successes and failures. Turn off this video and take action, but not impulsive action, strategic action. Write down your current thesis for silver or for avoiding silver. Write down your position size and whether it's appropriate. Write down your decision rules for future actions. Write down your time horizon. Creating this clarity protects you when emotions run high later. And they will. Markets guarantee it. Silver dropped from $117 to $103. This event matters less than how you respond to it. You now understand the context. You understand the mechanics. You understand the appropriate mindset. Smart money doesn't have a crystal ball. Smart money has discipline. Smart money has patience. Smart money has risk management. Smart money survives volatility and positions itself to benefit when opportunities emerge. You can be smart money, not through prediction, through preparation. Thank you for your time and attention. Invest wisely, stay disciplined, think long term.